Michael, thanks very much for coming on. We appreciate it. A very interesting interview we just had with Mark Faber, and he had previously called U.S. Treasuries a suicidal investment. He now says that over the next 10 days to a month or so, the short term, that he thinks they are a good investment. Do you agree with him?
You know, we don't even try to predict what would happen in 10 days, but if we look out 1 to 3 years, I think given the amount of fiscal indebtedness and given the better economic environment that you mentioned, the IMF, actually one of their biggest upgrades was on the U.S. Growth outlook. Those two factors, we just don't see a lot of value in U.S. Treasury. There are a lot of better opportunities elsewhere in the market.
Michael, that means no exposure along the curve here for U.S. Treasuries?
That's correct, yeah.
All right, so talk to us about those better opportunities. Where specifically? And if I remember from last time, I know it was a quick hit we did with you, some of the European nations you find interesting.
Yeah, not so much in the core of Europe. I think within the Eurozone, there's been a bit of optimism recently that there's going to be a new facility in place or some improvements, but really it comes down to the need for certain countries like Germany to open their checkbook and other countries to be willing to go along with some pretty tough rules. We're not sure if we're going to get there yet. But if we go a little bit outside, if we go to Central Europe, that was another area that the IMF upgraded in terms of some of their growth outlook. Places like Poland and Hungary that are really tied not so much to broader Europe, but specifically to Germany, which is the one bright spot in Europe, as it's a great export engine and has been feeding the demand in Asia. And so Central Europe has been doing well and actually have better finances than many parts of core Europe. Additionally, Scandinavia, very well-run countries, you know, very prudent fiscal policy going up to the crisis, which has meant they could spend without running into debt problems, something I wish we had the luxury here in the U.S.
Michael, what about, though, when the Chinese and the Russia step up and they say, hey, we're going to be buying some of those European nations, their sovereign debt, those that are in much more troubled situations? That doesn't give you any confidence in terms of the market outlook for those markets specifically?
You know, there is a lot of liquidity out there, and certainly what the Chinese do in particular is important. But we really look at the need for structural reform in Europe. You have a coordinated monetary union, but you do not have coordinated fiscal policy. And until the rules are in place to prevent another Greece, to prevent situations like in Portugal from happening again, I think we need to just wait and see what really comes out.
How conservative are you investing here, Michael? Because there is obviously a chance that Germany comes through with that spending, that the bigger countries come through with that spending. They enlarge the size of the funds that the federal government in Europe has at its means for disposal, and then they can reduce worries about having the liquidity to deal with a Spain or a Portugal if those problems should arise. Do you think that that presents a good speculative opportunity?
You know, certainly I think something will come about, and so we're not saying nothing will happen. Something will happen, but you're talking about a little bit of a knife edge that some of these countries are on, and we just find it much easier to go to places like Asia or Australia where you don't have to make this bet, will Germany come through or will they not? If they do, it's great. If they don't, it's a big problem. Would rather go to a place that, you know, it's all laid out. They don't have to have a new package or a program, and we can earn attractive yields and AAA credits at 5% yield in a currency that's tied to, you know, what's going on in China. That to us just seems a lot easier than playing some of these what-if games in Europe right now.
Michael, got about a minute left here. So you tend to hold your positions for 3 years. What position are you in right now that you think holds the most risk for you folks? Which one do you find the most confidence in?
You know, we certainly are finding a lot of confidence in how we think non-Japan Asia will perform against the euro, against the yen, and against the dollar. That's one that we have a pretty high conviction in. Those capital flows that keep coming into the region reinforce growth, bring in more capital. But one of the big risks that we see, and this is going to be a key issue for 2011, is do policymakers tighten enough and stay ahead of the curve? So far, so good, but they're going to need to remain consistently proactive in tightening fiscal, monetary, and exchange rate policy to prevent a bubble. So it's one of the best opportunities, but it bears a lot of watching.
Are you concerned about that here, Michael, in the U.S.?
I think we have printed too much money and spent too much money. You know, growth coming in close to 3% this year, and we still have quantitative easing and 0% rates. Yeah, I think policy is looser than it needs to be.